Hello everyone, and good morning, good afternoon, or good evening to everyone who is watching wherever you are this moment. Okay, here I'd like to welcome you to another episode of my company health check series, uh, which I will discuss American Express Quarter 2 2023 earnings, which was released last Friday. Okay, for those of you who do not know what the company health check series is about, uh, as if you haven't watched my previous videos, okay, here I will share my occasional updates of my portfolio companies that I invested in and currently still holding. Okay, so I will analyze them using the bottom-up approach, where I will look through the quarterlies, the quarterly reports, all the way to the full-year reports and beyond. So I believe that by journaling my research in video format, I hope that I can make myself more informed of my past decisions, whether it's right or wrong, and also share my insights with everyone here about the companies that I invested in. Hopefully, all of us can benefit in some way, and especially to you, fellow active value investors like myself who are watching. Okay, let's move on. So, American Express is actually one of the first credit card companies that pioneered, okay, the system of the credit card. Okay, it used to be a checking company, okay, a shipping and checking company. So long time ago, before the World War, they were a shipping company. So right after that, they had a business system of actually taking credit. Okay, so they found a way to actually take credit by creating the first credit card. So American Express actually was founded in 1950. Okay, the credit card company itself, it was founded in the 1950, and they were the first few credit card companies to be established after the World War, and it operates a closed loop system. Okay, so until today it's still operating as a closed loop system. Okay, and what the closed loop system means, I will share with you guys in the next slide. Okay, so just a comparison. All right, most of the peers actually of today operate in the open loop system. Okay, so for example, right after American Express was founded, Bank of America followed suit because they realized that the business was growing. So Bank of America came in to issue cards as well. And after that, they later developed it as a platform, which what we know as today as Visa. Okay, so Bank of America actually was the founder and creator of Visa credit cards. So Visa currently operates in an open loop system, okay, which I will share with you in the next slide. So what is the closed loop versus an open loop? Okay, so a closed loop system means that American Express has full control of the credit it issues to card users, while open loop system like Visa or MasterCard, they are just platforms. Okay, they work with a bank, and the bank is the one that issues the credit, while American Express, being a closed loop system, issues the credit via themselves. So they do not go through a bank, they issue the credit themselves. So by doing that, they are actually the acting bank. So American Express actually holds deposits as well. So by holding deposits, okay, they have full control over its customer profiles and the customer data. Okay, so by doing that, I believe that American Express has created a premium and exclusivity in terms of its branding. Okay, because they have to be more careful in terms of issuing credit. So their aim is to, since the 1950s, their aim is to target the higher net worth individuals. Okay, while Visa and Mastercard are generally mass market customer profiles, so they have minimal control over the customer. Being open loop, they have lesser control over the customers' information and data. All right, so uh, for example, okay, Visa and Mastercard, they because they have to work with the bank. The bank is the one that has all the data of the customers. All right, so Visa and Master just charges a platform fee to the charging bank that loans the money out. Okay, so this is the difference here, and because of that, okay, American Express exclusivity is my valued premium choice, okay, versus Visa and Master, because Visa and Master is more mass market, and American Express holds this exclusivity of controlling its customers' data, which is what I enjoy about investing in American Express versus the other two peers of the credit card business. Okay, so what is the weaknesses of actually American Express? Okay, so being in a closed loop system, okay, its weakness is that it may not be able to grow as fast as Master or Visa, okay, because their target is more of the premium market, while Mastercard and Visa card, they can work with as many banks as possible to issue their cards, so they can capture a bigger market share. All right, for like unlike American Express, because they issue their own cards, their capabilities is only limited to uh, uh, so much. So that's why you don't see many merchants holding American Express or accepting American Express credit cards. So this is a weakness here. Okay, the opportunities and market share is capped. So therefore, I consider American Express as a defensive play company rather than a growth company. However, even though it's capped in its opportunity to grow, okay, CEO has actually expressed his strategy, okay, to target the young affluent, okay, or the second generation rich. So notice that we could be looking at a generational business model. So like McDonald's, where customers are groomed to eat McDonald's from young, right? So when you are accustomed to eating McDonald's from young, you grow old, you also will still continue eating McDonald's because you're used to the taste. So likewise for American Express, uh, being a credit card company that maybe issued a card to your family members, the older generation, then after that they will sub a card to their children. So likewise, their children will get the same benefits, and then these benefits is hard to switch. So there's a switching cost to it. So American Express believes that by targeting the young affluent, this will also in turn uh, pass on to their children as well, so to the third generation, fourth generation, and beyond. So by doing that, they can already capture the system and hold on to the customers because of the benefits that they give. All right, in terms of the co-branding and partnerships. So the opportunities of why I like American Express, the opportunities of this company, okay, the opportunity framework that I see, okay, is that they also have long-term partnerships with premium market brands by doing co-branding. Okay, so an example will be the Hilton Honors American Express card, and this creates a premium branding goodwill. Okay, that, as I mentioned in the previous slide, if you have been using this Hilton Honors card, American Express card, for example, because you do not want to waste your points, you will continue using it because you're already a Hilton VIP member. Okay, and then your children as well, because once it's passed on to the children too will also have to use the card, the American Express card, to spend on the Hilton, to get the Hilton Honors benefits, right? So it's very hard. There's a switching cost here, which is what I really enjoy about American Express, is that they co-brand with premium partners that I think most other credit cards such as Visa and MasterCard, which is more mass market, they do not have this top of exclusivity brands that work with them. So the switching cost here is for American Express is much higher. So to target the younger market, as I mentioned earlier, is a good strategy. All right. And another thing is that why I invested in American Express, because of this opportunity, is that the closed loop model is proven to be defensive in the periods of crisis. So we did a study of how American Express actually performed during the 2009 and 2010 financial crisis. Okay, it actually still, it of course its results is weaker than the average, but again, their because of their ability to hold the customer's information, and then also the control of the data and the due diligence they did Okay, they survive much better than a lot of other banks out there, right? Because they themselves actually hold deposits as well, which is also definitely will be affected by the financial crisis in 2009 and 2010. But because they targeted the affluent market, okay, they survive much better than a lot of major banks out there. All right. So therefore, we could see some certainty should another credit crunch happen. Okay. So the similar credit crunch happen in the near future. So what are the threats? Okay, of investing in American Express. Okay, so one of it is I believe that peers of American Express are already heavily investing in fintech related businesses. So Visa and Mastercard, for example, they are already targeting the new generation of fintech businesses. So they invested in new fintech businesses that may replace credit cards in the future. For example, by BNPL, which is buy now pay later, apps have already taken over the younger generation. Okay, it based on the mass market. Okay, so they've been actually advertising BNPL quite aggressively to the younger crowd. So this may be a threat to the traditional credit card business. All right, but I believe that American Express, they have actually studied that these players may not be able to actually target the high net worth. So there is a gap to actually cater to the high net worth, and American Express is actually there to bridge the gap. And because it has an existing power of networks to ensure that the brand gets passed down to the next generations, I believe that American Express has this mode, this defensive mode, and which differentiates them from the other two uh, credit card peers of American Express. Okay, so let's take a look at their business segment sales. Okay, based on the Q2 2023 earnings results. Okay, here we can see that there's a slower rate of improvements in all business segments. Okay, which the revenue increases ranging from 1% to 12% relative to Q2 2022. All right. So in 2022, the earnings were much better. Okay, the rate of actually improvements in terms of the revenue. Okay, not earnings. Sorry, the revenue is much better. So currently, we see a slower rate of growth for Q2 2023. And it's the same in Q1 2023, where the growth rate this year has slowed much more than last year. Okay, so the top three share of revenue comes from Global Merchant Network, okay, with a 47% share of its revenue. And then after Commercial Services with a 25% share, and follow on by Global Merchant Network at an 18% revenue share. Okay, we should see all businesses segments continue to grow. Okay, due to the overall increase prices for goods for this year, and then of course also higher customer acquisition and high network volumes as well, because of continued spending ever since the lockdowns. So there will be growth for most of the segments in terms of revenue end of this year. Okay, so my conservative estimate is that this year's overall revenues will increase by at least 10 to 15%. But if you compare that to last year, I think that has been dampened because it has to take into account the higher provisions for bad debts this year. Okay. So you can see that based on the net interest income, the two largest segments have actually declined. Okay, so the two largest segments being the US consumer services segment, which has declined by 2%, and the commercial services segment that declined by 9%. Okay, these two segments decline mainly because there's higher credit provisions for default and also higher operating expenses charged to these two segmented businesses. All right. However, we can see that international card sales grew 27% and global merchant network grew by 16%. Because these two business segment grew because its revenue growth uh, in both of these segments exceeded its higher credit provisions and operating expenses. Okay, but when we look at international card services in more detail, they also actually had a reserve release of 5 million for the quarter. So that is why, because of this reserve release of this $5 million, uh, you can see a higher growth rate there at 27%. But if without this reserve release, okay, which is a one-off thing, um, depending on the portfolio of the business segment, all right, the growth rate will also be small. Okay, so let's take a look at the management outlook as per the second quarter 2023 conference call, earnings call last week. Okay, so CEO Stephen J. Squeri reassured that while American Express credit performance is stellar, okay, during the quarter two 2023 call, he also acknowledges that management still do see a couple of mixed signals due to the challenging environment of high interest rates and inflation. Okay, but he is, however, very focused on capturing the millennials and Gen Z, and this is on track. Okay, he mentioned that this portfolio actually grew 21% from a year earlier, which is a good sign. Okay, and also it currently represents over 60% of its new customer acquisition portfolio, which is quite a big deal. Okay, and CEO Stefan also reaffirmed that earnings growth will be in the region of 11 to 15% uh, by the end of financial year 2023. However, my financial year 2023 is more conservative. Okay, I estimated that um, there should be a decline, 5% decline at least, because of the higher allocated provisions and higher operational expenses going forward this year. Okay, let's take a look at the historical performance of American Express in terms of the profit and loss. Okay, summaries. So I have tracked American Express sales from 2005 to 2022. Okay, so I also included the 2023 6 months trailing uh, earnings for you guys to see. Okay, but what we can see here from 2025 all the way to 2022, American Express has shown resilience in its revenue growth. Okay, as you can see in the chart here, and net profit margins since 2005 have been double digit. Okay, and we only noticed that the net profit margins strength the most during the credit crunch of the 2009-2010 crisis, from double digit to just a single digit, which I highlighted in yellow here. All right. However, since the crisis, the profit margins have actually improved to double digits. As of recent, uh, we can see that it's come back to 17%. Okay, as of the latest 2023 6 months trailing is already up. Is already back to 17%, which is also close to the average. Okay, so I would think that the business environment for American Express, the American Express operates in, is indeed very cyclical due to the sensitivity of its interest rate and also consumer spending. Okay, which will affect the American Express portfolio. But because of its large and resilient portfolio, because of its ultra high net worth and high net worth clients, I feel that American Express is still considered defensive in this sense. Okay, let's take a look at the expenses. Okay, in 2023, 6 months trailing, its net margins is at 17%. Okay, So overall, I think that the net interest yield per card member still remains healthy at a double digit 12%. Okay. So we have to actually also take a look at the management strategy. Okay. So the management strategy is to target the affluent millennials and Gen Zs. So if the management actually were to make this bet correctly, American Express can fully capitalize on this and catapult its future value to greater heights. So bulk of expenses from card member rewards, okay, increased 15% as compared to quarter two 2022, while business development expenses were up 14% and card member services uh, grew the highest, up 48%. Okay, so this brings the total expenses compared to quarter two 2022 to be up 14%. Okay, but like I said earlier, we will see high cost pressures. Okay, eating into good margins at the end of this year. That's why I forecasted a lower growth in both revenues and net profits this year. Okay. Why is this so? Okay, why do I think that it will dampen its results is because of the higher write-offs, which is what the market is actually noticing. All right, despite its record earnings in quarter two 2023, which beat analyst estimates. Okay, but uh, I think investors are taking a look at the very great, very big increase in terms of their provisions and write-offs. So as you can see here, okay, if we compare this to quarter two 2022, this is a 147% increase in terms of its return of bad debts. Okay, with 871 million written off in quarter two 2023. Okay, versus if you take a look at quarter two 2022, it's only around 352 million. From 352 million to 871 million is quite a big jump, and it's only a 1 year period. All right, this remains a serious concern that has to be addressed by American Express. Okay, but of course, if you look at the write-off rate, this remains low at 1.8% versus the overall portfolio. Okay, but if you can take a look here at the quarter two 2023 rate, is actually at 1.8% versus the quarter one 2022 and quarter two 2022 rates. You can see the vast difference here. It grew by from 0.8% all the way to 1.8%. This is quite a big jump. Okay, even though the rate might look still very small versus compared to their larger portfolio. Okay, this remains a concern because in an economic blowout, okay, the tails will widen. Even though it looks like the rate is small, but because of unexpected economic blowout, the losses can grow and can wipe out the whole portfolio. This is a risk that I think American Express should actually address. Okay, and then this is what investors are actually taking a look, are looking at this moment is not so much of the results, but more of how they manage their risk instead. Okay, if you look at the balance sheet, okay, the balance sheet shows a slightly higher loan to deposit ratio in second quarter 2023 versus second quarter 2022, but both are still above the two times multiple. Okay, and it's still, if you look at the loan to deposit ratio, I think it's still considered quite okay, quite healthy. All right, but this steep increase in provisions for losses and the write-offs is still my concern. Okay, even though if you look at all the other things, other statistics, other data shows that it's low. Okay, but if you looked at the growth, it's rather concerning. Okay. So I also looked at the balance sheet funding mix. Okay, the balance sheet funding mix of as of second quarter 2023 also seems quite unbalanced. Okay, and any potential unfavorable event can trigger drastic losses because of the funding mix doesn't seem quite it seems to be quite over leveraged. Okay. However, the good thing is the long-term debt have been in constant reduction. Okay, ever since the global financial crisis in 2008. Before that, the long-term debt is much more greater than what it is today. Okay, so here we also see that its return on assets, okay, have seemed to decline drastically, okay, versus what it was in 2005. Okay, so before the global financial crisis, American Express used to earn like double digits return on assets. Okay, so currently it's just at a single digit, 2%. Okay, this is okay versus 2% versus 4.67%. Okay, last financial year 2022. Okay, so this is already, you can see the decline. Okay, from 4.67% last year, currently it's standing at 2%. Okay, and both years already is single digit. So the return on assets keeps declining. Okay, this is because probably it's due to the greater liabilities that American Express has taken over time, but because of the lower returns it generated due to higher expenses and higher write-offs, uh, as reflected this quarter. Okay, that's why you can see that the return on assets stands at a very low rate. Okay, generally American Express has negative free cash flow, okay, based on last year's results and this year's results as well, because of the increased loans provided to card members. Okay, this also means that business is good, okay, because they issue more loans. Okay, but again, I have to stress that American Express has to be really cautious and mindful of its write-offs. Okay, proper due diligence should be done, okay, on customers in regards to its credit rating, okay, and the loans given, and also some sacrifice has to be done, okay, if needed to dampen the issuance of loans, okay, to reduce further bad debts from swelling or snowpiling. Okay, so they might have to sacrifice some business to protect their portfolio. Okay, so this is a suggestion that American Express should consider, is not to so easily issue cards to uh, new card holders or new card members. They have to actually consider properly the profile of the Gen Zs and the millennials that they are taking on, and how to manage that risk in case of any bad debts that can flow from this group of new customer base. So if you look at the valuation, okay, American Express currently has a forward PE ratio of 15 times. Okay, its median PE ratio is at 17 times, and the industry is currently trading at 8 times. Okay, based on my PE forward valuation metric, American Express share price to me should be valued around $158 to $168 range per share. Okay, I think that overall industry, based on its PE ratio, seems to be fairly bearish, probably due to the fear of more collapse of banks because of the further rate hikes by the Fed, and also the increased loan defaults and write-offs by banks. As you can see, what has happened previously with a lot of smaller banks in the United States, right? So you can see that share price has been down, okay, from its previous high since the announcement of its second quarter 2023 earnings results last Friday. Okay, to date, it's currently already down 6.8% from its high of $178.76. Okay, today is I think about $166 as of today's market open or pre-market open. Yeah. So even though earnings beat analyst estimates, okay, markets seem to be spooked by higher write-offs within the business. Okay, based on my DCF analysis, okay, I valued American Express at $54 billion, or just 1.2 times its 2022 revenue. Okay, and as a relative comparison, okay, to my DCF calculation, current market cap of American Express is currently at $126 billion, okay, or 3 times its 2022 revenue, which means at current prices, the margin of safety is already lower for me, okay. So, but if I compare this with its peers, okay, it's still priced reasonably. Okay, Mastercard is currently trading at 40 times PE ratio, and Visa is currently trading at 32 times PE ratio. While, as I mentioned earlier, American Express at based on its forward PE is only 15 times currently trading currently. Okay, all peers have similar earnings per share at high single digit. Okay, in financial year 2022. So I think that American Express, despite it at current prices, it still has room to grow. Okay, if based on its relative valuation to its peers, okay, I still consider it fairly valued. All right, even though prices might have already gone up from its previous low, of course, probably due to its most investors actually looking forward to its second quarter 2023 earnings report. But ever since, of course, I said earlier, it's uh, come down around 6.8% to date. Okay, so prices already may have reflected its potential business risks. Okay, and American Express has to address the growing number of write-offs compared to a year before. So let's hope that the next quarter there will be some better news in how they would manage their larger write-offs as compared to last year. Okay, we also will have to look at its peers, vis-a-vis Mastercard and Visa, as to see how they are performing in terms of their bad debts. Okay, so if it's relative, then I think it's not very good as well, because if it's relative and most bad debts has gone up compared to last year by a large amount, that means the economy is not doing is at a risk of uh, greater default, and banks may be affected, and then it will affect all the other credit card companies as well. Okay, even Mastercard and Visa. Okay, so this will leave a dark cloud hanging for American Express. Okay, in terms of its valuations, until the management has actually addressed how they will manage the bigger write-offs as of this year. Okay, but of course, if American Express prices should come down any further, closer to my margin of safety, I will be buying more American Express shares. Okay, I believe that should a similar situation like the 2009 crisis were to occur, okay, I think that American Express being able to handle a 2009 crisis, because at that point of time, many banks are caught off guard. Okay, even American Express. So as if another 2009 crisis, another similar situation were to occur, I believe American Express should still be in a good position to counter the crisis because of its prior experience to such a large crisis that occurred in 2009, where everyone was caught off guard. So currently, I think if another one were to occur, hopefully they are more prepared for it. So that's why I'm hoping that management will be able to address its larger write-offs as compared to last year. So we should actually take note of this, and maybe in the third quarter we should take a look again how it's performing in terms of the bad debts versus its peers. All right. So I always believe that the key to invest, okay, is always to invest closer to its margin of safety, because if you were to invest at high prices currently, okay, like if you invest at the peak at $178, like I mentioned earlier, it went to the peak of 178 before the earnings results, and if you were to invest then you will be suffering a loss at this moment, right? So the key is to invest when it goes closer to a margin of safety, even though it looks very unrealistic. Okay, at just maybe 1.2 times its earnings. All right, but patience usually will pay off. So it's better to be safer than to get ourselves wrong in terms of our valuation, and then make a big mistake and we suffer a huge loss. Okay, so with this, I conclude my company health check series today, and let's take a look at today's market again, and hopefully you guys make more money. Okay, for the win. All the best, and we'll catch up the next episode. All right, have a good one. Take care.